In today's episode, I'm joined by Tim Carleton, the founder and chief investment officer at Auscap Asset Management. Tim and the team are exceptional. Their longest running fund has been going since 2012, and they have managed to outperform the market, which we know is hard to do, by 5.2% per annum since inception. In this chat, we unpack the investment process that has led to this amazing performance, and we talk about a lot of companies. We talk about REA Group, ResMed, Nick Scali, and JB Hi-Fi. And make sure you stick around for the end, where we discuss the advice Tim gives to the uni students when he guest lectures at Sydney Uni. It was a real highlight for me. This episode was made possible by the Australian Shareholders Association. We're really appreciative for their help and support to get someone like Tim on the show. I hope you enjoy. Let's start off with whereabouts did you grow up? Let's get some background on the Tim Carleton story.
Yeah, sure. I grew up in Sydney, and it's always interesting answering that question because I spent a lot of time traveling around the world, and I think the one thing you realise is just how fortunate you are to grow up in this wonderful country, and I can assure all your listeners that Sydney is one of the best locations in the world. I've been to a lot of cities in a lot of countries around the world, and geez, you win the lottery when you are born and raised in Sydney.
Yeah, whereabouts? What kind of area?
Up north, about 45 minutes north of the city. So
right.
Lovely part of the world, and very fortunate to grow up in a great household.
Yeah, fantastic, mate. Now, what was your first interaction with investing? Do you recall it?
Yeah, it's a good question. I mean, I think growing up, I was aware that my parents had some shares, but they didn't talk about it a lot. It wasn't. I wasn't born into one of those households where the dinner table discussion talked about stocks and how they were thinking about them. So really, it was when I got to university and I was studying a commerce and law degree at Sydney University that I first got involved. And I think I probably did what every first-time prospective share market participant does, which is I spent a lot of time punting on things that I shouldn't have been involved in, and it's probably the cheapest form of tuition that you'll ever get, losing money on the stock market when you're going through university days. So these days I actually guest lecture at Sydney University a couple of times a year, and it's one of the things that I always say to the students: punt as hard as you can on the stock market and lose your money now, because the bets are small in size, and that's to your advantage. You're going to learn a lot of lessons along the way.
They're probably all the stock market would be safe for the punting they're doing these days on the crypto and meme coins, and
that's probably true. That's probably true. It's low down the risk curve compared to some of the other things that are on offer.
Now, I've heard a bit about your journey through investing. I believe you came out of university and went to Goldman's?
Macquarie first. I went to Macquarie first, yeah.
Macquarie first and then Goldman's. Reflecting back on your career, who would you say would be the main mentors and influences as you came out of university and started to shape what the investor that you are today?
Yeah, I mean, if I reflect on the journey, I left university and joined Macquarie Group. I'd done a couple of internships at Macquarie and UBS before that. So I ended up joining Macquarie in their investment banking group. So primarily doing mergers and acquisitions type activity. But very quickly, I ended up on a team that was doing a principal deal. So a deal that was involving Macquarie's own balance sheet. And from that point, I really never went back to the strict advisory work. I spent a lot of time on deals that were principal in nature. So Macquarie investing their own capital to buy a listed or unlisted business, and then often putting those businesses into funds that they were seeking to manage on behalf of third parties. And you know, there are a number of brilliant minds that I worked with at the time. One of the directors that I reported into was absolutely fantastic at working out very quickly the rough valuation of sort of any business. And when you first join a company like Macquarie, particularly in that sort of team, you're doing a lot of the grunt work. You're deep in Excel models. You're building these, 15 to 25 tab models to try and spit out a number that supports a valuation, particularly if it's on an asset that you're bidding on. And so I'd be working away on these models, and this director would come over and he'd say, "How's the model going?" And I'd say, "Oh, it's great. I think I'm nearly finished. I've got a valuation," and he'd say, "Oh, where's it coming out at?" And you'd say a number, and he'd say, "I don't think that's right." And you're thinking, I've just spent 4 weeks on this model, and you're telling me, having not even looked at it, that you think that it's not correct. And so I asked, well, why do you think it's not correct? And he said, he pulled up a chair and he pulled out a pad, and he said, "Well, to cross-check a valuation, I think about other ways of valuing the business." And he wrote down his first way, and again, it was all of about 5 or 6 lines, and that made sense. He wrote down his second way. I mean, we got to a third and fourth way. I think by the time we got to a fourth way, he said, one way you could think about it is it's a real estate play plus a binomial option on future earnings growth. And he starts doing the option calculation, and all of his numbers were triangulating around a valuation. And he knew that the model needed to spit out a number that was roughly in line with that. And so from that point, I've always tried to think about multiple different ways of valuing a business, because it's a good cross-check against what might be your primary method of valuing a business. So, at Macquarie was a wonderful few years there. I learned a lot from the people around me, and then I moved into a completely different environment at Goldman's, where I joined a team that was managing proprietary capital again, but in a listed context. And that was where I really got my first sense of what managing money professionally looked like. And the Goldman's proprietary team were well known domestically and internationally. It was a very, very strong team. So I was lucky enough to work with some wonderful people inside Goldman's. And I think where they were strongest was understanding risk and reward. Goldman's had a very straightforward model for people in the proprietary team. You made money, you participated, and you lost money and you lost your job. It was a pretty easy equation. So when you're presented with that set of facts, you focus first and foremost on managing risk before you worry about managing money. And I think from that point, that's been a core part of my philosophy, that you want to manage the downside before you worry about the upside. And if you limit your mistakes when you're managing capital, then the returns will look after themselves. So through that whole journey, I've worked with some great people, and I've been lucky enough to continue to work with some great people inside Auscap. So Gavin, who's still with us today, I worked with it at Goldman's, very closely with at Goldman's, and he's still part of the investment team today.
One thing I've actually heard you say, and it's interesting we talk about risk here, is because I heard you mention as well in a different podcast, when you were at Macquarie, they were really hard. They were quite harsh on risk, and you were presenting to some pretty intimidating characters when you're presenting your work to them, and so people would be double checking absolutely everything. And rule number one there as well was not to lose money. So what were the things that you would routinely be double checking for, and what are those real risk management frameworks have you brought along with you throughout your entire journey?
I think in relation to the risk management groups that you would have to present to if you were suggesting an idea, particularly if it was an on-balance sheet idea, they had an incredible ability, even though you might have been working for months, if not longer, on a particular project, they'd have an incredible ability to get to the heart of the issue and the real 2 or 3 risks associated with making an investment. And they would do so very quickly, and then they would spend a lot of time drilling into your knowledge of those 2 or 3 assumptions. And they really wanted to test the downside part of that assumption. So it's no surprise when you think back to their early days, they spent a lot of time investing in businesses that had relatively little downside. I mean, they were buying toll roads and airports, and the downside could be quantified quite easily and was reasonably unlikely. But as Macquarie moved towards businesses that had more of an operating model, the focus remained at isolating the 2 or 3 key risks or key assumptions in a model that drove your valuation. And they wanted to know that you had the answers to the questions around, well, why do we think we can manage these risks? And when you think about investing in markets, there's lots of people that build pretty big models. The model in itself shouldn't give you any assurance. That the thing that's driving the model is a couple of key assumptions. And so we spend a lot of time thinking about the key assumptions. And after a while, you know what assumptions drive various businesses. It becomes almost intuitive. And so we spend most of our time thinking about those assumptions, measuring the volatility of those assumptions and what variance you might expect to see over time. And that's really important if you want to be a good long-term investor. You actually need to understand what's driving the valuation, what's driving earnings over time, and get comfort that that is a factor that's naturally positively in your favor.
So get to those 2 or 3 big meaty questions.
Exactly.
And spend your time on those.
Exactly.
And so if I was to say, what makes a good investment to you, in your opinion? It's a very broad question, but what makes a good investment to Tim at Auscap?
Well, it is a good question. I mean, we have a pretty narrow focus. I mean, we have said, I think, from very early in the journey that we think there's 70 to 80 great businesses in the domestic market. And that's in a listed market of over 2,000 listed stocks. And we're not interested in investing outside of those businesses. And the reason for that is to manage risk. I mean, good businesses tend to surprise you all the time on the upside, whether it's in a cyclically difficult period or in a period where things are going really well. And poor businesses tend to constantly surprise you on the downside. Every surprise announcement seems to be an earnings downgrade or some sort of unexpected shock that's hit the business. And actually, the recent tariff wars have demonstrated just that to us once again. So as a result, we focus on what we think are high quality businesses. Now, what are high quality businesses? They're businesses that have some form of competitive advantage or preferably structural advantage over their peers. And that presents itself in the form of high return on invested capital. So a lot of people know that they're looking for businesses that have higher ROEs or ROAs, but they don't really know why they're looking for higher return on equity businesses. And the reason is pretty simple. If you have 2 businesses and one is earning a 25% return on every additional $1 million invested, and another is earning a 10% return on every $1 million invested, there must be something about company A that is superior to company B. So it's our job to go and work out what that is, and then work out whether that advantage is growing, staying the same, or shrinking over time, because that will dictate how that business grows earnings in the future, how efficiently they do it, how quickly they do it. And sometimes that advantage is obvious. So if you take REA and you compare it to Domain, REA has 3 to 4 times the revenues of Domain, and yet and probably 4 to 5 times the audience of Domain. And so its revenues are a lot larger, but they've got to spend the same sorts of money on people, on tech, on marketing and advertising. And so as a result, it's probably no surprise that all of the economic benefit over time is accruing to REA and not to Domain. And, that doesn't necessarily show through every year, but it will show through time. So if you look at those 2 companies over the last decade or so, I think REA's earnings have gone up 200%, and Domains are roughly where they were a decade ago. All right. So all of the economic benefit is going to the company with the natural competitive advantage. Sometimes it's actually far more nuanced. So, we've owned Nick Scali for a long time, and you think it's a furniture retailer. Yeah, it offers a really nice product, but why is it that business is, I think, the only company in the listed market that since it listed 20 years ago, its average ROE is around 50%, right? That's extraordinary. So they go and spend another $1 million on a store and they're generating $500,000 in net profit after tax on that store, and they're doing it pretty quickly. Why is their return on equity multiples of other furniture retailers operating in the same market with the same conditions? And the answer to that is a lot more nuanced. And so we spend our time worrying about the nuance and thinking about the nuance and traveling with the companies that have both the higher return on equity and the lower return on equity to understand what their competitive advantage is, whether it's sustainable, whether it's growing, whether it's shrinking, because that's really what defines a great company. It has some sort of sustainable competitive advantage that we think is going to endure and deliver very, very strong earnings growth for the next 5, 10 years and beyond. So that's the first part. Don't get involved in poor quality companies because they'll constantly disappoint you. So if you narrow the pool of companies that you're really interested in to great businesses, that's a huge head start on the broader market. If you then think sensibly about valuation, and that's all we really think we do, we think we have a sensible valuation overlay. We'll buy more of those high quality companies when they're attractively priced. We'll own them if they're fairly priced. If they become a bit expensive, we'll own a bit less of them. And the ones where we just can't get to the valuation, we'll leave alone. That's really how we construct our high conviction portfolio. And, to some extent, a lot of good investing, I think, is about what you don't invest in rather than what you do invest in.
I'm curious, based on valuation and the high conviction and the limited amount of high quality businesses here available in Australia, and to be fair, around the world, really. I recently listened to a podcast with Chris Hahn, and he's a British hedge fund manager, and he said out of the entire investable universe, he thinks there's only about 200 amazing businesses or that meet his quality criteria. So it's no surprise that you say out of, the entire market here in Australia, there's only 60 or 70. And that would make sense as well when you have I think your portfolio will hold anywhere between, say, 30 to 60 businesses. Do you, given that there is a lack of great quality businesses here in Australia on those metrics, do you ever sell out entirely on valuation principles?
It's not normal for us to sell out entirely unless something has materially changed in the business. And that does happen from time to time. So a business that you thought had a competitive advantage looks like they're losing their competitive advantage. Or in some instances, historically, we've just been wrong about the competitive advantage. Alternatively, the company might start accumulating too much debt, and we're extremely wary of companies that have too much financial leverage because to some extent it takes the outcomes, if there's an unexpected shock, out of the company's hands and into the hands of the debt holders. And we never want that to be the case. So there are reasons, but more often than not, we will just trim our position and keep a very small holding. So, inside the high conviction fund that we run, the top 20 investments are typically 80 to 85% of the exposure. And given we normally hold around 5% cash, there's quite a long tail, and a lot of that tail is one of two groups of companies. The first group is businesses that we've owned for a long time. We want to keep consistency of tenure, and so we will reduce the position to a small figure, but not exit entirely, particularly when we think the valuation is overly stretched. The second group of companies in that list is companies that we think are high quality businesses where we can see a situation evolving, and we want to make sure that we see every development. And it's very difficult to watch a company that is not in the portfolio as closely as one that is. So we will often take a 10, 20, 30 basis point position in a business where we think we might get an opportunity so that we are really paying attention to everything that's going on in that business. And a good example of that is ResMed. ResMed was a sub 30 basis point position going back a number of years. And then we could see all of the hysteria sort of developing around GLP-1s, and we'd done a fair bit of research into that while it was still a very small position. And then eventually, the market really started to throw the baby out with the bathwater, I think late 23. And we got an opportunity at a valuation that we thought was incredibly compelling. But we'd already done all the work, and part of the reason that we'd done the work was it was in the portfolio. We were paying attention to this issue, and we thought to ourselves, this could really become a big issue that the market focuses on for a period of time. We think it's equally likely to be a tailwind as much as a headwind. And so if that stock becomes priced as though the tail risk is going to happen and we're still happy with the valuation, that's often when we're most comfortable buying. When the market is making the most bearish set of assumptions and pricing the stock as such, and we're happy with that valuation, even if the bear case plays out. Because if anything better than that plays out, then it obviously becomes a wonderful buying opportunity. And that's what it's, we think it's turned out to be in ResMed's case. So quite often we'll have companies that are in the portfolio where we just want to keep abreast of every issue, and you are better placed to do that if you own a small amount of a company than if you don't own it at all.
Yeah, it really sharpens the focus, and you've done the work, it's there, and you can dial it up as you see that moat or the competitive advantages expanding.
Yes, exactly.
Can you give us maybe an example, actually? I'm curious now to see a business that's in your portfolio or that has gone through that experience where you had it, again, like ResMed, but you had it as a small position, and you actually saw the competitive advantage actually continuing to grow and grow and grow, and that really built that confidence for you. Is there anything that comes to mind and you were able to add to that position?
Well, there's lots that come to mind, but probably the most obvious example is actually the same one, and it's a little bit nuanced in the sense that at the same time that all of this GLP-1 hysteria was going on, Philips were having recalls of their products, and Philips is the only other major competitor in that market. And it turned out that parts of their product were carcinogenic. They were actually sending bits of carcinogenic foam into the lungs of the users. And to make things matters worse, it appears as though the company knew about these issues for some time before it disclosed them. So all of a sudden, as a share of the market on new device sales, ResMed had the market reasonably close, reasonably to themselves. There's a few other small players that do slightly different things, but in terms of the CPAP machines, they had that market to themselves. And there was another development going off to the side that was really aiding one of their key inhibitors. Sleep apnea, which is what their devices look to solve for, is a condition that they estimate affects about 1 billion people globally. And yet I think there are about 24 million devices in market. So hugely underdiagnosed, right? A lot of people that have sleep apnea, they wake up feeling drowsy. They don't know why. What's actually happening is they're suffocating, 30 to 60 to even more than that times an hour as they sleep. And as a result, they wake up feeling drowsy, and it's a terrible ongoing experience. It's a recurring experience for them. Well, at the same time that all this was going on, a couple of the smartwatch manufacturers were actually developing a sleep apnea test on their smartwatches. And just in the last 12 months, both Apple and Samsung have come out with smartwatches that are FDA approved for the detection of sleep apnea. So you now have two of the largest wearable tech companies globally, and there are another 4, I think, that are seeking FDA approval, alerting people to the fact that you may have signs of sleep apnea, right? And most people go, I don't even know what sleep apnea is. They'll Google it when their phone tells them that when they wake up, and all of a sudden you've got some of the biggest tech companies in the world driving people into the funnel, straight towards effectively one company. So all of these other positives were going on at the same time, and yet they were, and to some extent continue to be, almost completely ignored because everyone is focused on this risk over here that they think has suddenly come out of nowhere and creates a risk for the business.
That's really interesting because I have read a number of, I remember seeing buy recommendations, say, coming out on ResMed around the time of the weight loss drugs, the GLP-1s. And I don't think a single one that I recall, that is news to me today.
Well, there you go. And it's pretty incredible. If you had a dream as a company, it would probably be, let's get the big tech companies to funnel patients towards us or customers towards us.
And in the meantime, let's have our main competitor bugger up.
Exactly. So they're a pretty unusual set of preconditions, and certainly our feedback from speaking to a lot of sleep practitioners, healthcare practitioners, in the US in particular, is that the wait list to get into a sleep practitioner is longer than ever. I mean, to the extent that it's blown out from weeks to more than a year in many cases, and some of the practices that we've spoken to have just stopped taking bookings altogether. So it is telling you that these things are pretty positive, but they're underreported because everyone's still focused on the impact of the weight loss drugs.
And so that sounds like a bit of a bottleneck, though. If you need to go through one of these specialists to then get one of these ResMed machines, sounds like a bit of a look. It's a good problem to have, but yeah.
Exactly. It's a good problem to have, and it probably means that you've got years of solid earnings growth going forward.
Just curious, valuation is quite important to the process. Do you continually add to your winners as well?
We don't continually add. So sometimes you'll get a shock or an event where you get an unusual opportunity to buy, and from that point, the position size will already be big enough. And if it's gone in your direction, the position size has obviously become bigger. So no, we won't often add. We generally have a rule that limits position sizing to in the order of 5 to 6% at cost. And so positions can be bigger than that in the fund, but it's generally through price appreciation. Obviously as the stock goes up, unless there's new compelling evidence that's even more positive, well, strictly speaking, you've got a larger position because it's gone up, but the stock is slightly less compelling potentially if there's no new, more positive information that's come out. So we wouldn't naturally be inclined to add in that situation. But there are some situations where uncertainty is so high, even within our numbers, that we will have a modest position. And if one of the more positive scenarios looks like it's playing out, then sure, we will add, because at that point in time, we have greater certainty that the uber bear case is not going to play out or is very unlikely to play out. And so it warrants a higher position because it's a high conviction investment idea.
In your portfolio, I know a lot of, say, quality focused investors might actually ignore highly cyclical markets like commodities. Is that the same with you guys at Auscap, or do you hold commodities? Because it's quite difficult in Australia to avoid them. You narrow your universe, but then they might not meet that quality factor for you.
Yeah, I think we've been underweight resources and underweight the banks ever since we started, but we don't think about things relative to the index in the high conviction fund. So from that perspective, when you do a quality screen, it's very difficult to identify a lot of companies that meet that criteria, but there are some. I think that the thing that you need to remember when investing in commodity companies, and I've spent more time in West Perth than maybe I care to, meeting with a lot of these businesses, is that the number one driver of earnings and valuation is the commodity price. So occasionally the market will lag what's happening in real time in a commodity environment. That's an opportunity. Occasionally you will see a part of a business that's commodity related not being valued at all. So that's clearly an opportunity. But to the extent that we see sectors with natural headwinds, we will be very reluctant to invest in even the best businesses. So take BHP and Rio, we don't own either. They are clearly the dominant players globally in the iron ore market. Our view, based on a lot of work that we've done, is that the iron ore market peaked in 2020 in line with Chinese consumption of steel, which looks like it's peaked and is falling. China are an enormous part of the steel consumption market. So to put that in context, they're about 56% of global steel consumption. And that sounds like a very big number, but it sounds even bigger when you consider that India are second at between 5 and 6%. So they are 10x India's consumption, right? And everyone else drops away very, very quickly. And so, our view is that they have probably overbuilt in the short term. They have a stable, if not declining, population. And so as time progresses, they're probably going to need less steel on an annualized basis. And so that's got negative implications for demand for iron ore and coal. And because they are such a big part of the market, it really doesn't matter in the short term as to what happens with Indian consumption or US or Japanese consumption, the next two biggest players after India, because it's a rounding error on what might end up being a pretty significant decline in Chinese steel consumption. So we are very cautious about that market, and the number one driver of BHP and Rio's performance over the next 10 years will most certainly be the iron ore price. So, we think when we're cautious about a space in the commodity environment, we'll actually just leave the whole sector alone.
That's fair enough. I was curious, actually, considering we're talking about this now, and I've got portfolio construction on the mind as well. When a position doesn't go according to plan, how do you manage that? Because, for example, in your portfolio for quite a while was mineral resources, and then I just noticed that it would be listed in the top 20 in your monthly reports, and then post February this year, that drops out of those monthly reports. It's no longer in that top 20. Do you exit those positions entirely? Because I know you dial them up and dial them down according to the your outlook and valuation, etc. But when something hasn't gone according to plan, sorry, my cat has just jumped up. Speaking of not going according to plan, do you exit it completely?
Yeah, it depends on the circumstance. I mean, mineral resources has been an interesting journey. So, Gavin and I have been following that from very close to listing, because we used to follow it and meet with the team when we were at Goldman's. So we know that company pretty well, and it was one of our bigger positions back in 2019 when we didn't think the market was valuing the mining services business correctly, let alone the optionality that was offered in other parts of the business. And then we had iron ore remained pretty strong over the following couple of years. And in addition to that, lithium went nuts, and they'd positioned themselves very nicely in the lithium market. So the stock went from around $13 to about $90. And normally you can see a top in a commodity market coming a mile away, and this was no different. All of a sudden, everyone wanted to own lithium stocks. The price had gone to what we thought were absurd levels. And there were signs from various mining companies of a top, expensive wine being offered at company dinners, famous people doing shoots and joining boards. There were lots of different indicators that had us very worried. So we ended up selling about 70% of our holding when, lithium prices were very high in the back end of 2023. And
what wine were they serving?
I can't remember exactly. We're more interested in the fact that they're serving it than I love my red wine, but I was probably more interested in that point in the fact that it was being served. So there are often telltale signs that markets have gone to levels of excess, and invariably things are cyclical, and what goes up a long way can come down a long way, and that has happened to such an extent that it's even surprised us. So we were still holding sort of 25 to 30% of our position. We had the initial decline, and then obviously, to our surprise, because we've known Chris and the team for a long time, there were the corporate governance issues that emerged. But the really problematic part of the equation from our perspective was twofold. One, for the first time ever at the back end of the lithium cycle, they weren't behaving counter-cyclically. Historically, they'd been very, very good at divesting when prices were high and investing when prices were low. And this time, they were buying parts in speculative lithium companies at valuations that we thought were pretty full, which was a very un-min-like thing to do. And it pretty quickly gave them a leverage issue, because at the same time they were trying to build Onslow, which remains a pretty substantial iron ore operation. It doesn't matter how big you are. I mean, they're ultimately trying to deliver 35 million tonnes per annum, and then probably move beyond that to closer to 50 or even more than that million tonnes per annum. So it's a very significant operation, and it required leverage. And so the other uses of capital that we think were maybe a little bit misguided in early years have added to that pile. Now, the problem with leverage, as I mentioned at the start, is it amplifies returns in both directions, but it's particularly problematic if suddenly you get hit by the unlucky stick and something comes out of the blue. And obviously in the last 4 or 5 years, we've had a lot of those, but lithium has continued to decline. So today, it's not much above $600 a tonne. So that is problematic because their operations are probably loss-making, and they're still trying to ramp up this iron ore operation. Obviously, the issues there are well telegraphed. So, we got to a point where we realised this leverage issue really is an issue, and we're struggling to see how they get out of it in the next couple of years. So this is an unusual instance in that we effectively cut it to zero because we just couldn't see a path forward. CapEx kept blowing out, timetables kept slipping, and the commodity price weakness that had been experienced since late 23 has continued and probably got worse in both the lithium and the iron ore markets, which are their key markets. So if facts change, it's a good thing to it's a good tangent to go on. If facts change in relation to an investment, you have to change your facts. Your evaluation. You have to reassess as though you don't own it. And if that reassessment results in you thinking that this is not a great investment anymore, then you should immediately take action. So the moment we thought, actually, we can't see a way forward given the leverage problem, we cut pretty hard.
So you, just recapping there, you de-weighted on that boom up to, I think, about, say, $90-ish when it got there. And so you weren't at a full position when the governance issues and things like that came to the fore, but also it was already in your mind kind of deteriorating as far as the quality factor was concerned, and also that change in how management are acting as a counter-cyclical style investor raised a few beige flags for you.
Yeah. They weren't beige; they were red flags. We talked about them at the time. Listen, the company has still been, probably one of the top 10 investments that we've had over its whole life in the fund. So, and to be honest, we do think that the management team have done for many years a great job in maximising value for shareholders. But I think, in this instance, maybe there was a little bit of excess in the market just because of how far lithium had run. And at that point in time, everyone was of the view that some form of lithium bull market was going to be sustained, even if prices fell back a little bit. Now, it hasn't turned out like that. We're seeing lithium prices in the market at the moment that we last saw in 2018 before the whole boom even started. So, we're probably less critical of management than a lot of the press. But the facts change around the investment case. They have a lot of leverage. They're now heavily exposed to iron ore, where we're outright bearish, and lithium, where at the moment the prices continue to decline. And, that's causing problems for every hard rock lithium producer in the world. So that puts them in a difficult and delicate position, I think.
No, fantastic. And you take that position to zero, and look, it's something you can check back in on. And once again, if those facts change, you can resume that position.
Yeah, exactly.
If it's attractive. I went back through and looked at your fund returns, because a lot of investors in Australia, a lot of new people coming to the market are well educated on ETFs and how difficult it is to beat the market, etc. And you guys do hold medium to large cap businesses and have outperformed significantly in your main fund. I wanted to zero in on just a couple of years, because there's a saying, to do something, to beat the market, to get a different return from the market, you have to do something different to the market. I want to know, in 2013, 15 and 2021, those were exceptional years for your particular fund. And for those people who haven't seen it, in 2013, your performance figure in the fund was almost 52%. 2015, it was 36%. 2021, it was 43%. These are just amazing numbers. What were you guys doing differently in those years? Do you remember those particular years? I imagine it would have felt pretty good.
Yeah, well, I think that the key is that we weren't doing anything different. So investing is a very strange profession, in the sense that effort doesn't immediately equal outcome, right? And most people, if they think they've done a really good job at something, they want to see it reflected in performance and therefore compensation and the like. And investing is not like that. Your process will yield the appropriate results based on the quality of the decision making over a long time period. And there will be years when the wind is at your back and you look like you're absolutely, crushing it. And then there are years when you look pretty terrible, and there can be times when actually your decision making in the latter year was better than the former year. It's just that everything that you did or the stocks that you hold went really well in that former period and didn't go well in the latter period. And that's what makes it such an interesting journey. I think our decision making in the last 3 years has been probably the best of the 12 or 13 years that we've been managing capital within Auscap. And yet they're not the best 3 years from a fund performance perspective. In fact, far from that. I mean, last year, pre-fees, we only just managed to beat the market, even though I thought we had a great year from a stock picking perspective. And that's because we don't own the banks. We don't look anything like the market. And the banks drove more than 70% of the performance of the All Ords. And we don't own them. We don't own CBA, Westpac, NAB or ANZ. And the reason for that is we think a lot of people really complicate investing. I mean, from our perspective, we are not trying to be the smartest guys on the street. Far from it. We just have a very, very simple approach. And our approach is that the longer you spend in our fund, the more your return is going to be a function of two things, really, and two things only, right? One is the dividend yield that our companies produce, and two is the earnings growth that they deliver. Because if you assume over long periods that valuations don't really change, there are periods when market multiples are high, when the market multiples are low, but the moment you get to sort of 10 years plus, actually the impact of a few PE points on the multiple actually becomes less and less important if you think about how indices have performed over time. I mean, the fund's up 470 something %. So, only part of that can be attributed to multiple expansion or compression. Over long periods of time, the two things that really matter are what cash am I getting out of the company and how are their earnings growing, so that if the multiple on those earnings stays the same, that's the obvious driver. And if a company does 1,000% earnings growth over a decade, then clearly their share price is going to be up a heck of a lot. If a company does no earnings growth over that period, then it's very likely that the share price hasn't moved at all. So if we look at the big four banks, why don't we want to own them? Why haven't we owned them? Because we predicted 10 years ago that they wouldn't exhibit any earnings growth. And surprise, surprise, their earnings growth has been close to zero. In fact, even CBA, since we started the fund in 2012, I think it has done about 2.4% EPS growth over that period, right? So we think the only sustainable way to generate returns is to find businesses that are going to consistently grow earnings over time and then hold those businesses for a long time. Now, if we can add a little bit to that by buying a bit more when they're cheap because everyone's freaking out about something or other, and conversely sell a little bit when they become expensive, because markets are cyclical, sectors are cyclical, stocks are cyclical, so everything will rotate around that earnings line, then yeah, that adds a little bit to returns, and that's great because we're watching it every day. But the key driver is if you go and look at the long-term stocks that we've held, they've exhibited very strong earnings growth over time, and that's the main driver for performance. And some years that'll get recognised and you'll look like a hero and you'll get lots of compliments for investors, and other years it won't. And at the moment, any genuine active manager is finding it difficult to keep up with the market because there's not really a lot of logic to being as overweight as the index is in the big four banks, given all of the headwinds they face. In fact, we think the next decade might be even more difficult than the last decade, because in the next decade, you've suddenly got a competitor in Macquarie Bank that's decided we want to play in this market. And we don't have the corporate overhead that these guys have. We don't have a branch network, so we don't have that whole cost. We have the best tech stack. We've got a very good way of attracting high quality deposits, right, at a relatively low cost. So all of a sudden, you've got a competitor that's currently a little bit less than 6% of the market that's taking more than 3 times that share on a run rate basis. So the outlook from our perspective is that it's going to get harder for the big four banks to maintain their share, not not easier, and that's going to make growing earnings difficult. So, we look very different to the market because we don't care what the market looks like. We're looking for high quality businesses that we think will sustainably grow earnings. And if we buy those businesses at attractive prices, then any investor that's in the fund for a long enough period will see their return approximately be similar to the dividend yield and earnings growth that those companies have delivered. So that's really our focus, and that's why it's very important to us that we give no consideration to the index, because that's not going to drive longer term returns. It might help you deviate less from an index over discrete 6-month, 1 year periods, but it's not going to deliver outperformance.
On the 80 odd high quality stocks in Australia, are there any particular sectors where those 80 are clumping, or is it business models where those 80 are clumping for you guys, or is it fairly well dispersed, across the sectors here?
It's a great question. I mean, we have tended to be overweight consumer discretionary names since we started the fund, because we think there is an abundance of companies in that space that are really high quality businesses, either clear domestic champions or in some cases world beaters. And they often don't get priced for their quality simply due to the fact that they're cyclical. And the final part of that is because they're cyclical and their earnings will display some form of cyclicality, so they might be growing at 20% per annum but have big cycles around that, we often get opportunities where earnings are depressed at the same time that the price to earnings multiple is depressed. So, we're always keen to take advantage of that. So particularly relative to the index, which I think has about a 7% weight in consumer stocks, we tend to find ourselves overweight that space. Similarly, there are other sectors where we really struggle. I mean, we always really struggle in mining stocks because mining companies are very good at consuming cash and not very good at giving it back. And you find that time after time, and it's very difficult for management teams to act counter-cyclically in those industries for whatever reason. When times are good, it just feels like times are going to be good forever. And so a lot of capital is wasted rather than returned to shareholders. And then, conversely, there's no appetite to do any M&A when times are tough, which is exactly when you should be doing M&A. And if you haven't saved a war chest, the interest from investors for capital raisings at that point is normally pretty low. So historically, we've almost always had an underweight exposure to mining companies because we just don't find the requisite characteristics for a high quality business in that space. And you can see it over time in their ROEs. Their ROEs will look fantastic when commodity prices are high, but through the cycle, they'll still typically look, unfortunately, pretty average.
I guess it is returned to shareholders in a way when they're having the Penfolds at the annual meetings.
I'm not sure that's a quid pro quo.
I just want to quickly touch on when you're at Sydney Uni and you're doing your guest lecturing. What are some of the real key rules that you want to impart on these people that are the students that are watching you? It could be around portfolio management, as you discussed, but maybe common mistakes or something. What are those real key takeaways that you hope they do actually take away from your sessions?
To be honest, I love my time guest lecturing at Sydney, and I do it for an amazing class. I mean, if any listeners that attend that university are listening, study hard, get good results in your first couple of years, and if you get a pretty good average, then you can get into this portfolio management course run by Jerry Sevek, and you're actually managing university money, which is pretty extraordinary. So they've got an endowment style money. Yeah. So they've got more than $600,000 that started off with a smaller amount, but it's grown over time, and they actually get to make investment decisions around that portfolio for a year. I mean, this is unheard of. Wasn't there when I was going through university. I mean, what a great course, right? So get your distinction average, get into the course. It's unbelievable.
It's like the ASX share game on steroids.
It is. And so they form small teams and they, operate, each small team has a sector or two they're looking after. There's typically only about 20 to 25 in the class. And I'll go in for 3 hours. I mean, I'm amazed that students listen to a 3-hour lecture, but the reason they do is most of it's interactive, and the conversation will really go wherever it goes. But I typically start the same way, and I get their portfolio beforehand. And I love getting the portfolio beforehand because invariably they make the same mistake that I think almost every retail investor makes, when they're inexperienced. And that is they're always overweight things they have no idea about, right? And they're typically in the most complicated sectors. So I will ask them before I come to organise the sector lists in order of these are the least difficult businesses to understand down to the most difficult businesses, right? And then I will also get them to order another list, which is these are the companies you're most familiar with in your day-to-day life, and these are the least familiar. And then I'll get into the lecture and I'll put up the percentages of their portfolio in each sector. And invariably, there is a clustering of exposure around the companies they are least familiar with and are most complicated, right? And it's a great way of introducing the old adage that, Warren Buffett once said, which is, I don't need to jump over 7-foot bars. I look for 1-foot bars to step over. And the same is true of retail investors, even ones that are professional that have been in industry for 20 years. I mean, the number of times I will catch up with someone that has a niche area of expertise in the unlisted world, and yet they don't use that information to their advantage in investing in the listed world. And we've had lots of these recently. I mean, virtually all consumer stocks went nuts coming out of COVID and even right at the start of COVID. And yet very few people that I know that run small retailers or furniture shops or, other areas of expertise went and then bought the listed companies that, were their peers that they must have known were doing well because they're seeing their own small retail shops, sell more stock at better prices, at better margins than they ever had before. Instead, people love going and putting $5,000 or $10,000, or it might be $1,000, into some speculative gold company that they heard about for 5 minutes on the weekend at a barbecue. And I think about the fact that that's the same person that would probably spend days often investigating where they can buy the cheapest 55-inch television to save $49, right? And they just go and spend $5,000 or $10,000 like it's going out of style, buying something they know nothing about, and without any realization about the risks. I mean, I love to, almost every time this class has an investment in a gold company, and I like to say, do you guys realize what a gold company is trying to achieve? And of course they don't. I say, well, normally you're looking for gold deep underground. They get that. So you've got to drill a hole down, right? And then put down a mine shaft and try and excavate ore that you hope has some gold in it, but you don't know. And they say, well, what do you mean you don't know? And I said, well, typically you'll have drilled a hole that's about this big, about the size, that's smaller than the size of your hand, at 25-meter intervals from surface. And then you're trying to extrapolate what might be between, but you don't know that. You'll only find out when you get down there. And then when you get down there, often the grades are maybe a couple of grams a ton. So you're looking, if you think about a ton of material, it's a lot of material, you're looking for typically half to one tic-tac, right? And it's not sitting there as a tic-tac. You don't go, oh great, I've found the tic-tac, let's put that through the mill. It's spread in sprinkle dust, right? And you've got to put it through an incredibly complicated process to then extract the gold, to then turn it into gold bars for it to then sit in a vault for eternity. But, it's a very, very difficult process, and obviously much higher gold prices has made that process still remarkably profitable. But the idea that you should go and invest in a speculative gold company you know nothing about, when you're not a geologist and you have no experience in the mining field, is incredible to me. And that's despite the fact that I have spent plenty of time going down mine shafts, in WA and around the world, looking at these sorts of operations. In fact, I'm due to go to another 3 gold mining companies inside the next couple of months. So, yes, stay within your circle of competence is probably our number one rule, which is why, you typically don't find us invested in particularly fancy businesses. They're businesses that we're familiar with. They make money today. They're already the market leader. We don't have to make gigantic assumptions that they're going to become profitable or that one day they'll rule the world. They're already very dominant, and they've still got a lot of opportunities for organic growth ahead of them that we think are much, much higher probability than a lot of the other companies that you see in the market. So we're trying to give ourselves the best chance of success by narrowing that pool of companies that we'll invest in down to what is a pretty small pool.
It's funny, these Sydney uni kids and most investors, probably never been down a gold mine, but they've been in and out JB Hi-Fi their entire life and never considered buying the stock. And yet it's been one of the market's absolute best performing stocks by a country mile.
There's a corollary to what I just said, which is the reason a lot of people don't buy stocks that they are inherently familiar with is because they understand the risks. And the moment they understand the risks, they think that they're incredibly scary. Well, actually, no, you're in a perfect position to then evaluate if suddenly you and your friends aren't going to JB Hi-Fi anymore and they're starting to use Amazon all the time and they used to be massive JB Hi-Fi nerds, right? That actually, that's a change in circumstance that can in fact impact that position. Conversely, if 5 or 10 years ago you read about all the fear-mongering around JB Hi-Fi and the fact that they were going to completely lose out and disappear from existence, and yet you knew that no one was using Amazon, and every time you needed a new laptop you went straight to JB's and everyone loved it, and a lot of people there were working there and they were telling you things are going really well at the company, you would never consider buying it when in fact that was actually your opportunity. You had a competitive advantage because yes, there was a risk there, but you were actually reasonably well placed to assess it. And often it's as simple as that. I mean, we have consumer stocks. We do a lot of really boring walkarounds, just seeing what customers are buying, how busy shops are, those sorts of really simple things to assess trends. I mean, I'm probably no different to a lot of other experienced and passionate stock market investors. My wife now doesn't even complain if we, wherever we go, if I start asking about how business is going to the person behind the counter, because I'm just interested in a way that I think you have to be if you want to be a good investor.
Yeah. And you'd be the oldest person in a Leviza shop by a long way.
I have been in more Leviza shops than any teenage girl listening to this podcast. So we have spent a lot of time on the ground, particularly in the US, in lots of different states, visiting their Leviza operations, because that's really that's a big opportunity for them over there. So we've been assessing how they've been going against their major competitor, Claire's. So yes, it's a little bit unusual when I walk in, so I normally make a beeline for the store manager just to explain who I am. And invariably I've got 2 young daughters, so invariably I walk away with a couple of pieces just so that I've thanked them for their time. But yes, I do spend a lot of time in Leviza stores.
Fantastic. Look, I don't want to take up too much more of your time, but there's 2 questions that we always ask people. Tim, if you were to go back in time and tell your younger self a piece of advice about life, business, or investing, what would it be?
Well, on the investing side, if you're passionate about investing, read as far and widely as you can. I mean, you're welcome to come and see us. We've got hundreds of books on investing, because when I developed a passion, which was probably really at Goldman's when I had my first taste of managing money in the public markets arena, I just wanted to get my hands on everything that anyone had ever written. I mean, the amazing thing about finance is no one that was broke at the end of a career in investing decided to write a memoir. So if there's a memoir out there, the chances are it's from someone that was very successful and wanted to pass on their wisdom, and they thought a lot about it. And so we have a rule in the office that you try to spend more time reading stuff that took longer to prepare. So that means spend the most time reading books that have been written at the end of people's careers, spend more time reading annual reports, and try to focus very little on, say, the notes that a broker produces because he's got to punch out 3 emails that morning before the market opens, right? So if you think about that, it's just logical. But if you're interested in investing, try to read everything that you can, and you'll work out your investment philosophy, your style. If it's for life, there's probably 2. 1, learn the power of compounding and learn it early. And if you can start saving and get on that investing journey early, it will set you up for later in life very, very well. And there's nothing like having the freedom to do what you want when you want. And the way you achieve that is financial independence. And the way to achieve financial independence is start saving and investing from as young an age as you can. And probably the final one on that side is if you're trying to achieve anything, I am absolutely convinced that the number one rule is to have perseverance. I mean, I've never met a successful person that just didn't persevere. Everyone goes through really difficult periods in their profession, and they just take the next step. So always take the next step in the journey, persevere, and I think the rewards will look after themselves.
Awesome, mate. And something a little bit more lighthearted. Me and you are going to lunch. The out of office is on. Where are we going? We're not going back for the day, by the way. So where are we going? What are we eating? What are we drinking?
It depends. At the moment, there's a gold bull market happening, so maybe we should be in an office in WA with a gold miner. But listen, mate, I have a 3, 5, and 7-year-old, so I'm just happy we're going to lunch. If there's a location that serves a good steak, or I love my Japanese, so it'd probably be one of those two, and we'd probably be having a cheeky glass of red wine, but. To be honest, I'd be more delighted that we're actually going to lunch. so that sounds like a good idea.
I've got a 3-year-old as well, so I'm in the same boat. If we're lucky, we'll get out to the pub and have a bowl of chips.
Exactly. That's normally our Sunday go-to.
Yeah, excellent. Tim, this has been great, mate. I've really enjoyed it. We'll put some links in the show notes to how people can find out more about Auscap. But look, we'd absolutely love to have you on again. So thanks for joining us, mate.
Thanks for having me.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.